These macroeconomic charts will blow your mind. They blew mine. Let's dive right in. First up, yield curve inversions have preceded the end of Fed tightening cycle. So just for some context, the Federal Reserve is tightening interest rates, raising interest rates, and crashing a lot of the economic fundamentals in the process. And because of that, we have yield curves inverting or flattening, meaning the longer dated bonds have similar or lower yields than lower bonds, even though they're more risky. So that's factoring in very weak growth, if not a recession. It's always an indicator of recession. So that's why we have this chart, which shows that once the bond curve inverts, the Federal Reserve tends to stop tightening because they know a recession is coming. And so you can see whenever the 2-year, 10-year Treasury yield spread goes negative, meaning it inverts, the Fed funds rate, which is the black line at the bottom, the higher it goes, the more they've raised interest rates, tends to stall. They can't raise it any further. And so historically, this trend is rock solid, and it makes a lot of sense. The Fed has political pressure, and it's not here to crash the economy because that makes politicians look bad. So once the yield curve inverts, they step in and save the economy. So let's figure out if this time is any different. Let's dive through the fundamentals with more charts. First up, this chart paints a crystal clear picture of how impactful rates are. So orange is the NASDAQ, black is the real rate, and it's inverted. And so when the black line goes down, rates are going up. And you can see how perfectly correlated the stock market is to interest rates. And so if rates keep rising, like the Federal Reserve continues to threaten they will do all through 2022, they think that they're going to raise another 100 basis points plus. That seems aggressive to me. Because if they do, US stocks will absolutely crash. Maybe we'll get a dead cat bounce here and there, but this trend is rock solid. And here is another chart signaling what is happening to this economy, at least in terms of confidence, because of these rate hikes. Number of S&P 500 companies citing recession on earnings calls. We are higher than when we were in the midst of one of the worst crises the United States has ever faced, which was the pandemic in 2020. So we've gone right back to those depressionary levels just with the tightening of rates. Here's another chart from Tavi Costa, Crescat Capital. U.S. financial conditions versus S&P 500. Red is the Goldman Sachs U.S. Financial Conditions Index, plummeting straight back down to the pre-pandemic levels or the mid-pandemic levels when the world was falling apart, just slowly but surely careening down there. And then you have the S&P 500 in white, just waiting to follow suit and crash along with it. The question is, when will the Fed step in? Projected loss in commercial real estate valuations by metro area. Obviously, you have rising rates, you have rising mortgages, not to mention the fact that more people are working from home. So commercial real estate is absolutely falling apart in this environment, which is obviously going to have ripple effects all throughout the economy. A shrinking demand for office space may lead to a drop of up to 43% in the value of San Francisco commercial real estate compared to pre-pandemic levels. Devastation. And so why is the Federal Reserve doing this? They're doing it to fight inflation. If the economy slows, people will stop spending money, inflationary pressures will go down. Their thought is that the economy was overheated, so we have to bring it back a little bit. In my opinion, it's causing way more damage than they anticipated based on all the data we've been walking through these past weeks. And so what the market is hoping for, the current narrative, is that inflation has peaked. Commodities are coming down. Once that happens, the Federal Reserve can go back to its old ways and just stimulate the bubble back up. And so has inflation peaked? Well, let's look at some more charts, some indicators. This comes from Liz Ann Saunders. Wage growth came in at 6.7% in August per the Atlanta Fed wage tracker. Rate has been same as both July and June, continues to hover at record high. The Federal Reserve is not going to stop hiking interest rates / destroying the economy while this is still the case. This is historic wage growth causing massive inflationary pressures. People have money, they're going to spend it. So they need to keep the pressure on. Then we have US food prices hitting an all-time high. People thought maybe food had peaked a few months ago. That is absolutely not the case. Look at that strong uptrend it's in. Sticky inflation. Let's go to Europe, which is facing the most significant energy crisis in the last 100 years. This comes from the Financial Times. The terms of trade shocks in Europe are large, even by the standards of the 1970s. So compared to the 1970s, which everyone talks about as a massively stagflationary period, which you have in dark blue, and then in baby blue, you have 1974, 1977, and then 2022, gas crisis, historically high across the board, except for maybe the UK. And so Europe is just in a spiral right now with an energy crisis on their hands. That is not deflationary. Then you have this from Alessio, diesel stocks. So this is showing the stocks of diesel fuel historically in 2022 in the dark red line compared to its average. So in the beige line, you see the 2017 to 2021 average. We're well below that now going into winter. And in the blue line, you can see 2021. So we have very low diesel stocks heading into winter, well below average. You can actually see that in the 34th, 35th week, normally there's a bump in diesel stocks to get ready for the winter as it's used up later in the year. Well, right now we're pretty low there. It does not seem like that energy crisis is ending. Now, of course, they are doing everything they possibly can to acquire as much fuel as possible from around the world. They are doing that. That is why gas prices have fallen. I did show a chart in the last video showing that they were at their target for reserves for what they wanted for gas. But again, got to look at the entire big picture. That's why these charts are helpful. So in my personal opinion, based on where sentiment is, you have to be contrarian. Why? Because being contrarian tends to really work out, especially when you have opportunities like we have right now. We're at the extremes of sentiment. Look at this absolutely mind-blowing chart. This is my favorite chart of the week. Institutions bought a record amount in hedges. This is how short they are. Last week's panic hedging was 3 times more extreme than in 2008. This is historic fear, panic selling. That line is always wrong, especially the more skewed this line is, the more wrong it is. You can see the last time it pumped was pretty much at the top of the bubble in late 2021 before the Fed tightening cycle. Now they've gone the exact opposite direction. Panic fear is setting in and replacing the FOMO euphoria that we had in 2021. And then you have this chart showing that asset managers boost bearish bets on the yen to a record. So the white line is showing the dollar to yen. The dollar goes up when rates are going up. The dollar has been skyrocketing and crashing everything around the world, including foreign currencies, because the Fed has been tightening rates. And so you can just see asset managers continue to bet on that white line going even higher. And they have hit an extreme, a record. You can see the light blue lines at the bottom. They are at an absolute extreme bearish positioning. So what this says to me is that we are ripe for a short squeeze, a nice sucker rally for maybe for the next few months. So sentiment is at the extremes. And when that happens, the crowd all gets squeezed. They all try to leave the same exit at once. And a massive clearing of all those positions happens. And that's how you get a short squeeze. So right now we are absolutely primed for a short squeeze. I could still see a massive pump in markets happening because the market still seems to think that peak inflation is here, right? And whether it is or it isn't, the Federal Reserve is tightening into a massively slowing economy. They're not going to stop tightening in 2022. And the market just right now is on life support, trying to survive this tightening cycle, and it's just not happening. The data is falling apart. So I could see one last rally ahead to sucker in as many people as possible before we get stocks to really start to reflect the underlying rot in the economy. This stuff takes time to work its way through. Normally when bond yields invert, it takes months. And so would I be surprised if stocks rally into the November election? Absolutely not. Now we will stay on top of this incredibly exciting market. Again, my favorite positioning is just keeping that small hedge on, maybe 2 to 5% of your portfolio in a short-term hedge position, but stack those high quality longs just in the events of short squeezes like this. and also do what the billionaires do and hold the highest quality assets for the long term, and you should do pretty well. Thank you guys for watching. We'll stay on top of this market.
This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.